Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the week ended Wednesday, August 27th, 2014. Investors injected about $17 billion into the conventional fund business this week, and this is after learning that we had better than expected reports of consumer confidence, U.S. housing prices were on the increase, and last but not least, we saw good durable goods orders come in as well. And this set the stage for some new records. For the 31st consecutive time we saw the S&P 500 this year hit a record, and as most people know, on the last 2 days of this trading week of Tuesday and Wednesday, we actually saw the close of the S&P above the 2,000 mark. So that was really something that kind of set the stage and really put us into a good flows week. Let's see how that panned out as far as our macro groups go. We saw about $400 million, that's about it, go into equity funds. $2.8 billion were padded into the taxable bond fund group. Muni bond funds took in about $0.4 billion, and money market funds actually took in the lion's share of all the flows, about $13.3 billion. I don't think we'll be surprised once we get that to see where it went into. Let's take a focus look, though, at equities to see how this panned out. For the third consecutive week, we've seen positive returns. This time it was about plus 0.86%, so it was a kind of a nice return for the week. We have, for the second consecutive week, seen net inflows, again, only to the tune of about $400 million, but how that broke out is, if we take a look at it, domestic equity funds actually took it a little bit on the chin. About $500 million, or 0.5 billion, went into the group, and this is a 6 week in 7 that we've actually seen outflows out of that group. So it hasn't been all that good for domestic equity funds. However, the story continues for non-domestic equity funds. For the 37th consecutive week, we've seen inflows. This week, to the tune of almost $1 trillion, we saw about $0.9 billion come into the conventional fund business this week for that. So as we're taking a look at it, we saw that the small cap funds actually took it on the chin, the worst, $0.4 billion. But if we took a look at the small cap, large cap continuum, really all three of the groups, mid cap, small cap, and large cap, all lost money on the domestic side. However, if we take a flip look and look at the international non-domestic group, we actually saw international equity funds taking about $700 million and emerging market funds taking in about $300 million. So overall, it was actually very strong flows that we saw, again, for 37 consecutive week in the non-domestic equity side. Let's take now a quick look at how ETFs panned out and what the flows did for there. For the third consecutive week, we saw inflows, this time from about $5.7 billion. The Industrial Select Sector Spider Fund took in the largest amount, about $800 million into that group. iShares MSCI Hong Kong actually saw some good numbers as well, about $600 million go into that group. Now, on the flip side, if we take a look at what the losers were, we saw ProShare Ultra Pro S&P 500 lose about $200 million, not that much, and the Spider GLD lost about $190 million. So again, the story of outflows was not that significant, but we can see there really was a tale of two cities when we compare conventional funds, where the retail investor was trying to hang out, they're still a bit scared, and the authorized participants from ETFs. Well, let's see how the flows actually impacted the fixed income community this week as well. For the third consecutive week, we've seen inflows, $2.8 billion this week. This is a third consecutive week. We've seen plus side returns as well, 0.3%, so not too shabby at all. And how this broke out, we saw that the corporate investment grade debt funds actually took in about $1 billion. This is the 17th consecutive week they've seen inflows, but a subset of that, loan participation funds actually saw outflows, about $300 million in outflows, and this is the 7th consecutive week that we've seen outflows. So obviously investors are not all that concerned about interest rate increases from the Fed, at least not in the immediate future, as they were in almost all of the last year period and early part of 2014 as well. One of the things, though, that we've seen is people willing to take on more risk, and this is to achieve yield. High yield funds took in about $600 million, and this is the third consecutive week we've seen flows go into this group as well. Well, let's take a look now at ETFs. The ETF side of the group really was kind of a ho-hum week for them. Only about $200 million net coming into that group. This is the sixth consecutive week we've seen positive flows into the ETF fixed income side. And how it started off was we saw iShares 20-plus Treasury bond ETF take in just about $150 million. But if we take a look at the bottom, the iShares Core U.S. Aggregate Bond Fund ETF actually lost about $270. Again, really quite a ho-hum week for ETF fixed income, but certainly kind of on the trend that we've been seeing lately. Now let's take a look at Muni Funds, because that's been kind of a good story. $423 million, third consecutive week we've seen inflows. Seventh consecutive week we've seen actually plus side returns, and that was 0.23%. And had we include ETFs in here into this count, we actually would have had 7 consecutive weeks of inflows for this group. So that was kind of amazing. If we take a kind of a finite look, though, we do see there is the game of national versus single state. Single states seen outflows. National munis actually took in about $450 million. Again, a little bit shy. The $423 million inflows shows us that single states actually saw some outflows this week. It's the 7th consecutive week, though, that national munis have attracted net new money into the group. Well, that brings us to our last group, and that's money market funds. Again, as I told you, it's the biggest group that took in money. It's the 4th consecutive week they've seen inflows, $13.3 billion this week. How that broke out, taxable money market funds saw about $15.3 billion in net new money, and how that continued to break out is institutional investors put in $17.9 billion. So they were a little bit on the conservative side, parking it on the side, whereas the retail investor actually took out about $2.6 billion. Looks like they might have put it all back to work into equities, right, in the international, which we were talking about earlier. Now, on the tax-exempt side, we actually saw outflows, about $2 billion in outflows out of that group. And that makes sense as well, because we've seen actually more inflows, outflows out of money markets, inflows into the muni bond fund side as well. So that's where some of that money has gone. Well, that's it for me today, but actually before we move on, let's take a look at where we may be going. And that's where I take a look at this morning's news. We had lower than expected personal income and a slight decline in consumer spending. Now, I don't think that's significant. I think investors were actually anticipating some of that. They actually readjusted the personal income. It looked a little bit better. So really this next week, we have the Labor Day weekend coming up on Monday. We've had very, very low trading. Maybe when investors get back, seeing that some of the economic news has been pretty good, and even though it was lower than expected consumer personal income and consumer spending, we still may be able to get a little bump out of the week coming up, and we'll be able to tell you that on the following Wednesday. Well, my name is Tom Rosine, and if you want to get a little bit of deeper dive, you can actually either go to our website at lipperusfundflows.com or come back next week and join us when one of our analysts will talk about flows for the following week, less Monday. We hope you have a good Labor Day weekend. My name is Tom Rosine, wishing you the best in your wealth planning and creation.